right, Tom, for a final segment today, we're going to do, we don't even call it education. We just call it 5 good minutes. And this week, we're going to talk about, you had a better word for it. I'm going to call it municipal bonds. What do you want to title this segment?
Let's talk. Let's call it tax efficient income strategies.
All right. I love it.
With
So the focus that I'd like to start on that is we'll talk about MLPs and some other things another time. But for today, the biggest one is just municipal bonds. So for those who've ignored this asset class like everyone else for 15 years and only really bought stocks, municipal bonds are typically tax-free. They're issued by state governments, by cities, by utilities, by water districts. There's various levels of quality. Detroit is the only city that comes to the top of my mind that's defaulted relatively recently. Overall, the default rate on municipal bonds is about 0.5%, so a very low rate of that. The yields tend to be very low. So if you're going to go out just for the first few years and you're looking at, high quality rated, so AA and higher, not basically where the U.S. government just got downgraded to, you're only going to get about 2.25%, maybe 2.5% for those first few years. And so one of the things you have to know about municipal bonds is that they are tax-free. And so you have to do a quick calculation to see what that yield is, and that's called tax equivalent yield. Would you like to jump in here, or do you want me to keep going?
Yeah. And just a couple comments. One, municipals is a unique asset class because it's 100% retail driven, meaning corporations aren't buying municipal bonds because they don't need the tax-free income. It's mostly for individuals like yourselves, high net worth, or just retired looking for tax efficient strategies. So to your point, when you look at the municipal market right now, yields typically are lower because they're tax free, but you have the spread right now is the widest it's been between taxable and tax free. So there's what's called a muni tax equivalent, meaning if you take the same duration, so let's take the 30-year treasury at 4%, the tax equivalent muni is trading at 6% right now, meaning you're getting about 3.5% on a municipal bond versus 4% on a treasury. And if you factor in taxes, that 3.5% is really closer to 6% if you're in the highest tax bracket. So that spread has never been wider.
Yeah, the government bonds. So like the U.S. Treasury, for example, you can look at the after tax, what that yield would be. And so Today, let's say that it's 3. Well, we're going to get taxed on that at a 40% rate at your top tier. You're only going to get to keep, 2/3 of that, 60% of that or so. So then you're really looking at, okay, it's 2%. So even though these yields for, high quality municipals, they seem low, they're actually a lot higher. And the best example is those high tax states. So if you live in New York City, you have state tax, you have city tax, and you have federal tax. So if you add all those together, your tax rate is 55.6%. So if you were to do a municipal bond and you were to buy it, and let's say it yielded 3.5%, your tax equivalent yield would be 7.88%, which means that you'd have to buy some of the worst high yield companies out there to get that kind of return. And instead, you can buy some pretty high quality AA rated municipal bonds.
Yeah, and one of the biggest risks with just bonds in general is obviously interest rate movement, but is default risk. And if you look at municipal bonds versus corporate bonds, so not treasuries, but versus corporate, defaulting over the last 10 years, there's different tranches you have from credit quality, from AAA all the way down to CCC. In every single tranche, you had a lower default rate in municipals versus their respective corporates. Also, when you look at municipal bonds versus, say, government bonds, you look at state and local debt right now as a percentage of GDP. It's low. It's about 14.5%, 15% versus.
Well, you know why that is, though, right?
Our government debt at 97 versus GDP.
The states and the cities have to have a balanced budget. They have to. They're legally required to, versus the federal government doesn't. And so they're at 122% of GDP because they can be. Right. Yep. The cities and states, they have to pay all their bills every year. And so they don't have the choice to go, we're just going to run a deficit. No, there's no deficit.
Municipal bonds are great too, because a lot of them are revenue driven, toll roads or, sewer bonds or whatever they may be. Obviously there's risks in any asset class, but right now to your point, because of where yields are, the tax equivalent yield is very, very attractive in municipals. And I think it's a great place to be, as opposed to just sitting in a money market or a CD that's taxed very differently.
Yeah, so the couple things risk-wise to make sure we address is interest rates. So if interest rates rise and you own a municipal bond that doesn't mature for 20 years, the value of that bond is going to go down. If you just keep that individual issue, so not in a fund or in an ETF, and you hold it to maturity, it will mature at par. But in the interim, you're going to see a much lower price on your bond. The other thing to consider is that quality matters a lot. So if you're going to go buy some of these cities that we know are not that well run, that recently got bailed out after the midterm elections, they got a lot of money and kind of fix their balance sheet that way. I would focus on high quality. So you can look at some general allocation for high qualities, whether it's a school district or a city, but you can also look at revenue, sewer and water debt when they go build out the utility companies, that infrastructure. That can be really high quality. I mean, what's the old joke? I think Warren Buffett goes, what's the perfect investment? It's a toll road where it's already completely built and it never has to have any maintenance, and you can just charge higher tolls. They build out these toll road authorities. So it's a good situation from a credit quality, and there's always ratings on them. So you can find these by, Fitch, Moody's, other places do these ratings, and you can see, okay, where do you want to take a risk? And so I think that at least single A, but probably double A and higher is pretty high quality. And then the last piece is just liquidity. Because these are individual issues, if you wanted to go and sell them, there's not always a market. Now, most of the time there is, but there's been a couple examples I can think of. I mean, March of 2020 is a great one where there was no action. There was no bids to go buy these. So you were then stuck with them and the cash flows that go with them. So there is some of that risk. So as far as sizing in the portfolio, you want to keep some emergency funds and other things in more cash-like a money market or T-bills. But if you want to go out and say, okay, I'm going to take a portion of my portfolio, get tax-free income off, and borrow 15, 20 years out, high-quality munis and making 6% on a tax equivalent basis is pretty attractive.
Yeah, no, it's a good point. I mean, I have a lot of clients asking about CDs, and I know you do as well, Kevin. And you just have to remember the yield and the income you're getting on a CD is taxed very differently than on a municipal. So you have to factor that in. And the higher your taxable bracket is, the more typically, generally speaking, municipals would make sense because, again, of that tax equivalent yield.
You could just not want to pay taxes, right? So even if you're on a lower tax bracket, let's say you're 28% or 22% tax bracket, and you're like, I don't want to pay at this level. It doesn't have the same bang for the buck, but you're still going to get, a 3.5. Maybe it becomes out to 4.5 or 5%. It's something that's worthwhile when I just don't want to pay any more taxes. So in Texas, it's great because all your state income is exempt because there is no state income tax. In other states like California and New York, you do have to typically buy their state's bonds. So it can still be some of their toll roads for revenue bonds and other things, but each state has different rules. So make sure you work with a good CPA and figure out what yours are before you just dive in and find out, wait, but I bought these California bonds, but I live in New York. That's not exempt from interest. Not for state income tax, it's not. So it's something to make sure you buy in the right ones, and working with a good financial advisor and a CPA, having your whole team together and evaluating all those risks. It's a really powerful vehicle.
Yeah, no, there's three buckets. There's ordinary income, there's capital gains, and then there's tax free. So you want to have a good mix, and everyone's different. So, well, what else you got, Kevin?
Well, I would just say that, as far as the yield curve in municipals, it actually is more favorable. It's more normal. So if you're wanting to borrow for 5 years, those rates are lower than if you're going to lend out for 15 years or 20 years, as opposed to in the U.S. Treasury market right now, you can get a higher rate on 6-month and 1 year than you can on 10-year and 30-year. So it doesn't make sense. It's inverted. So I think that this asset class is something that many people have ignored for a while, and it's something to learn about again. And as you mentioned, it's dominated by retail. There's a lot of different funds that buy these as well, but I think that it's a good fit for most people. And as far as sizing,
I agree.
We always consider diversification. Don't buy all of it in one issue, right? Spread it out between different states or different municipalities. Don't just buy your local city and, oh no, the city went bankrupt and now you have a new problem. So diversify in municipal bonds matters as well.